Could Ethereum really climb to $700,000 or will it stall somewhere around $15,000? Cathie Wood from Ark Invest, known for her moonshot projections on innovation stocks, envisions Ethereum one day trading near $180,000. Longtime strategist Tom Lee thinks it could go even higher, while former Wall Street analyst turned crypto entrepreneur Vivek Raman has gone the furthest, predicting an astonishing $700,000 per coin. Even Coin Bureau, a channel usually praised for its cautious tone, has stepped forward to outline the bullish case for Ethereum's long-term potential. Every one of these forecasts reflects a different future for the network, its expanding role in finance, technology, and global infrastructure. The range between these numbers may sound wild, but then again, so did early predictions for Bitcoin before history proved them right. In this video, we're unpacking the visions behind each of these calls from Cathie Wood, Tom Lee, Vivic Raman, and Coin Bureau, exploring the logic, the assumptions, and the possible outcomes that could shape Ethereum's path as we head deeper into 2025. Before we jump in, take a second to hit subscribe if you haven't already. It costs nothing, it helps the channel grow, and you can always unsubscribe later. Let's begin with Cathie Wood's take.
But what's different from Bitcoin treasuries, like MicroStrategy, now Strategy, is there's just more utility that these Ether treasuries can offer. Staking being one of the most important ones. The Ether ETFs are not allowed to stake.
Cathie Wood has built her reputation on making bold calls that critics often dismiss at first. One of her most famous predictions came in 2022 when Ark Invest estimated that Ethereum could someday reach a market capitalization of around $20 trillion. That would translate to roughly $180,000 per coin. At the time, it sounded absurd to most of Wall Street, but Cathie argued that disruptive technologies are almost never fully priced in until they are already changing the world. To her, Ethereum represents far more than a cryptocurrency. It is the foundational layer for an entirely new kind of financial system. Ark has continued to look for creative ways to gain Ethereum exposure without taking on regulatory or structural risks. For much of this cycle, Ark's funds were limited by the same rules that govern traditional ETFs, which restrict how they can hold or stake digital assets. Until recently, that made direct Ethereum investment difficult. Now that spot Ethereum ETFs have entered the market, those barriers are beginning to lift, but Cathie has also shown interest in treasury-style vehicles that can hold and stake Ethereum directly. These structures avoid overlapping fund fees and complex bad income tax issues that can threaten an ETF's compliance status while still allowing exposure to price appreciation. Cathie has also drawn clear distinctions between Ethereum and other blockchains like Solana. In her view, Solana may excel in consumer-facing applications, but Ethereum's deep decentralization makes it far more resilient. That security, she says, is what matters for a network expected to carry trillions of dollars in financial activity. She often highlights one additional advantage of the treasury model. Unlike an ETF, a treasury can stake its Ethereum and earn a steady yield, adding real income on top of any price growth. Cathie has called that a major structural difference between Ethereum and Bitcoin treasuries, and one of the reasons she believes Ethereum could eventually reach valuations that seem impossible to most investors today. Now, let's move on to Tom Lee's prediction.
Well, to me, Ethereum's having its Bitcoin 2017 moment again. And to give perspective, in 2017, Bitcoin was under 1,000, but that was the year when Wall Street discovered that the narrative of Bitcoin is digital gold, and Bitcoin has gone to 120,000 now, so 120 times increase.
Cathie Wood's $180,000 target for Ethereum already sounds wild, but Tom Lee takes that conviction to another level. As a Wall Street veteran and co-founder of Fundstrat Global Advisors, Lee has spent years studying crypto cycles, and he's convinced Ethereum is setting up for a run that could rival Bitcoin's historic breakout in 2017. Back then, Bitcoin traded under $1,000 before exploding more than 100 times higher. Lee believes Ethereum sits in that same position now, only with a much bigger role in the global economy. It isn't just a digital asset anymore, it's the settlement layer for decentralized finance, tokenized assets, and a growing list of real-world applications. Lee has compared Ethereum's potential market expansion to the early internet. network value rising exponentially as adoption spreads. In his current outlook, he sees Ethereum's next peak somewhere in the $10,000 to $20,000 range, with upside beyond that if global liquidity and institutional demand remain strong. His reasoning is simple. If Bitcoin can capture the digital gold narrative, Ethereum can capture the world's digital infrastructure narrative. He also points to what companies like MicroStrategy did for Bitcoin as a preview of what might happen next with Ethereum. Once regulations around staking yield and corporate custody mature, Lee expects more firms to start adding Ethereum to their balance sheets, using it as a productive digital asset rather than just a speculative one. For him, Ethereum represents the next generational trade. The setup, the adoption curve, and the liquidity backdrop all rhyme with Bitcoin's early supercycle, but with a much broader use case this time around. Now, let's move on to the highest prediction coming from Vivek Raman. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Vivek Raman comes from deep inside traditional finance. Before turning his focus to crypto, he spent more than a decade trading fixed income and credit at Morgan Stanley, UBS, and Deutsche Bank. In 2024, he founded Etherealize, a company built with backing from the Ethereum Foundation and Vitalik Buterin. Its mission is simple: help banks, asset managers, and large corporations understand Ethereum's infrastructure and start integrating it into their own systems. Raman isn't calling for $700,000 overnight. His immediate target sits closer to $80,000, a level he believes Ethereum could reach once institutional adoption matures and the market begins treating Ethereum as a fundamental portfolio asset rather than a speculative trade. The $700,000 figure comes from his long-term valuation model, which scales with Ethereum's potential to evolve into a global settlement network underpinning much of the digital economy.
But I think a $10 trillion asset is not out of question for global infrastructure where many new economies are building on, and that means an 80K ETH. So I think we've almost been in this PTSD thing where ETH has been performing so badly price-wise for so long that people just don't dream big anymore. You're like, oh, we were trying to get to 10K last cycle, and then there were a lot of market forces that didn't, and then FTX blew up and everything. So I don't know. I think we have to dream a lot bigger. I think we're building the infrastructure for the whole global economy, and that's a $10 trillion asset. So higher. My target's higher than anyone else's, but that
80K is definitely up there.
I mean, 706K is really up there too. But no, I just think that we're going to reprice, it will be Bitcoin, then it was Bitcoin, then it will be Bitcoin and ETH. And I think more and more it's going to become, hey, why don't we just do ETH? And you're seeing that. Bitcoin mining companies are switching to become ETH treasury companies. Everyone we talk to about these treasury assets, they're like, oh, we know why Bitcoin is backing some of them, but now they're starting to say, wait, you can do more with ETH. So why would this not be a better treasury asset? And that's where all this begins, so I'm excited to let that narrative play out.
Raman points to several key forces behind his forecast. The first is the arrival of spot Ethereum ETHFS, which finally lets pensions, insurers, and corporate treasuries gain exposure to Ethereum the same way they do with stocks or bonds. The second is supply. Since the merge, Ethereum's issuance has dropped sharply. Much of the existing supply is now staked, locked in smart contracts, or tied up in long-term holdings. What's left on exchanges has fallen to the lowest levels in years. With so little liquid supply, even a small wave of new institutional demand can drive prices up fast. He also points to corporate adoption. A growing number of companies are adding Ethereum to their treasuries, mirroring what MicroStrategy did with Bitcoin in earlier cycles. Meanwhile, the network is now being used to settle stablecoins, tokenized funds, and even digital bonds. Each transaction burns Ethereum as fees, reducing supply further. To Raman, this isn't speculation. He spent years studying how money flows through global markets, and his conclusion is that Ethereum is becoming their digital foundation. An $80,000 Ethereum represents his first major target once institutions are fully positioned. The $700,000 scenario, in his view, is the long-term outcome if Ethereum continues to evolve into the core settlement layer of global finance. Coin Bureau has long been known as one of the most careful and data-driven voices in crypto. Their content usually focuses on risk management and market structure rather than bold predictions. But even from their cautious perspective, the latest numbers still point toward a strong case for Ethereum. They highlight that the Ethereum to Bitcoin ratio fell to 0.017 back in April, marking its weakest point in more than 5 years. Since then, it has recovered slightly to around 0.023, though Ethereum remains down over 30% against Bitcoin for the year. The same trend shows up in spot ETH flows. Bitcoin-linked funds have attracted about $49 billion, while Ethereum products have drawn roughly $4 billion. At first glance, that might seem like a sign of underperformance, but Coin Bureau sees it differently. They argue that $4 billion in inflows is still significant when measured against Ethereum's smaller share of the total crypto market, and that the gap could narrow as institutional allocation broadens through 2026. Corporate demand is telling its own story. Charlink has accumulated around 88,000 Ethereum for its treasury, while Coinbase and BitDigital hold roughly 115,000 and 24,000 respectively. Bitmine is also climbing the list after completing a $250 million private placement dedicated to building its Ethereum reserves. In a recent CNBC interview, Tom Lee connected this growing trend to the rise of stablecoins, explaining that as traditional finance merges with crypto infrastructure, companies want direct exposure to the networks facilitating that transition. On the fundamental side, Ethereum's picture is mixed. Annualized mainnet fee revenue has dropped about 73% from last year, and daily Ethereum burn has fallen nearly 99% from its peak. Competing chains like Solana have absorbed some of that activity, yet Ethereum's scaling ecosystem is now doing much of the heavy lifting. Layer 2 rollups process over 10 times more transactions per second than the mainnet itself, which means total network usage has never been higher even if base layer metrics appear weaker. The derivatives market is also signaling growing confidence. Ethereum futures on the CME are now trading at a slight premium to Bitcoin futures, an indication that institutional traders expect stronger performance from Ethereum in the months ahead. In the options market, some investors are hedging with downside protection, but the largest open positions are still calls, bets that Ethereum could double before the year ends. For Coin Bureau, the message is clear. Ethereum's fundamentals may look uneven, with revenue and burn activity still recovering, but market behavior tells a different story. Institutional positioning continues to tilt bullish, and that alignment gives more weight to the ambitious long-term targets from Cathie Wood, Tom Lee, and Vivek Raman. When the cautious analysts start finding reasons to believe, it's a sign the rest of the market is already beginning to catch on. Some of the more optimistic traditional asset managers have also issued their short-term targets for Ethereum heading into 2025. Firms like VanEck expect a strong year, though their projections sit far below the massive long-term calls from Cathie Wood or Tom Lee. VanEck's latest target sits at $6,000 by the top of this cycle. In a December 2024 outlook, the firm pointed to several catalysts supporting that view. Continued stablecoin adoption, expanding DeFi activity, and the introduction of spot Ethereum ETFs that have opened the door for institutional investors. They also noted potential regulatory changes allowing staking and in-kind redemptions within ETF structures, which could strengthen Ethereum's position as a yield-bearing institutional asset. VanEck's broader model also assumes Bitcoin could reach around $180,000, putting the Ethereum to Bitcoin ratio near 0.033 at the peak. Ark's short-term view lands in the same zone, while Cathie Wood maintains her long-term conviction that Ethereum could reach $180,000. Ark's 2025 scenario lands closer to $8,000. Their model ties that range to the rollout of staking features in ETFs, the tokenization of real-world assets, and greater regulatory clarity. In a 2024 report, Ark compared Ethereum's evolving role to that of US Treasury bills in digital finance, as tokenized funds and bonds begin to settle directly on-chain. Together, these forecasts from Vanek and Ark create a cautious but confident range between $6,000 and $8,000 for the end of the cycle, a realistic midpoint between today's institutional adoption phase and the far more aggressive valuations proposed by Cathie and Raman. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.